Russell's ripping out of the gate here for Trump 2.0, but of course, over the last year and basically always, it's paid more to bet on big tech, at least by recent memory. Joining us, Brad Klappmeyer, Senior Portfolio Manager of the Large Cap Growth Team at Macquarie Asset Management. Brad, good morning. Thanks for being here.
Yeah, good morning. Happy to be here.
So our initial reaction to post-inauguration is rally the small caps, and few of the big ones are getting sold. What do you think? Is that the right move, or should we stick with the big tech?
I mean, it's important to recognize how strong big cap has been over the last decade. I mean, Russell 1000 growth, the big cap index has put up almost 16%, 17% annualized returns over the last 10 years. That's amazing, right? Unreal. But I think there are a lot of things to think through. Obviously, we're hopeful on inflation. We're hopeful on the economy. We're hopeful on the administration. We're hopeful on AI thematics. That's a lot of hope kind of residing in large cap. And a lot of that's aggregated in these mega cap names. So we're going to have rubber meet the road, meaning that the market expectation that we're going to have perfection out of these mega cap names has to come true. And unfortunately, things aren't always perfect. So I think the market's got to be in the right mindset that it kind of broadens out here over 2025. And maybe investors should use a lot more discretion when we think about those mega cap names. There's lots of good stuff out there to consider outside of the mega caps.
Seems like you're willing to at least put a decent bet on the tech names in LRGG, your large growth ETF. Tech's like 46%. What kind of leadership does that then have you banking on? Any particular names, any particular styles or sectors?
Yeah, you're spot on. I mean, a lot of the concentration out of the mega caps has also come from the technology sector. And I would even say when you're thinking technology, even broaden it out a little bit, right? I mean, Amazon's not in technology, but I think we know it's pretty much attached to technology as well. And Google's not in technology, it's in communication services, but we could argue that's a quasi-technology name as well, along with Meta. So there's a lot of weight aggregated up in technology. And so as a large cap growth investor, you have to know what you're doing in that space. And we do have interest. We think there's a lot of quality that exists in technology. Obviously, these are white most businesses. There's a reason why Google and Amazon and Apple and NVIDIA are all trillion cap companies. They earned it there through strong competitive moats, strong revenue growth. So we're still interested in a lot of those names. We think there's a lot of fair value still exists in the Googles and the Amazons and the Microsofts out there. We do use a lot of discretion when it comes to that group. We think Tesla has a lot to be concerned about, meaning that in a market where there's a lot of behavioral tendencies that exist, a lot of emotion right now in terms of momentum, we think investors are not always seeing with a clear head about the reality of what's going to happen. I think what we've seen over the last 12 months or so is Tesla is a cyclical auto company. And I think people are leaning maybe a little too far into these hopes and dreams that exist around autonomous driving and robotics. So I think we just need to be careful around some of these technology names.
I do see Tesla absent from your top 10. I see, as you mentioned, Microsoft, NVIDIA, Apple, Amazon, Alphabet, a few of the big five. Visa's in the mix. Motorola ranks pretty high in your weightings for the fund, just shy of 5%. Tell me about that one. That's a pretty interesting pick.
Yeah, as I mentioned, we're always positioning for quality. That's unwavering for us. And we believe the word quality gets used a lot, probably becomes genericized, and we think, unfortunately, it gets misappropriated. We think a lot of people say they do quality, but we're skeptical that everybody really stays in that lane. Motorola Solutions is a perfect example of why you don't have to lean up that risk curve to really find something unique and really high quality. So what that company does at its core is just land mobile radios. So public responders, first responders, police, firefighters, those are those radios they wear on their shoulder every day. And that's a great market. But what Motorola Solutions has been able to do is take that embedded position in land mobile radio and really enter video surveillance, enter command center software. These are both higher growth and higher margin businesses. And when you can find an entrenched position in a company that has these core adjacencies and it can drive a lot of success over years and years and years. And that's what it does. You don't have to lean into a significant AI thematic or think about interest rates or think about what the Fed's going to do in 2025. These are just good business fundamentals that we're looking for.
All right. Love that. I got one more that I wanted to hit with you. Intuit. From the software side, from the tax side, the shares have been basically stuck for about a year, but a stock that usually has trouble going down too far. What do you want to see from them, and how do they incorporate AI? Because it seems like that's the kind of big fulcrum for a lot of these software companies, whether or not they're going to use that to their advantage or not.
Exactly. I think you hit on something so important. I think what investors are trying to do now when we think about AI is really invest in the picks and shovels companies. And that's been successful. The NVIDIA's, as a specific example of how we're investing in the GPU infrastructure as we build out the hardware and the data centers, really to drive AI on the front end. But in reality, if it's going to matter, if it's going to really be something long term, companies that have some unique data set, have a competitive moat around their business, can do something that others can't do with AI, are really going to be those investments. So if you look across the portfolio, look across the index, companies that have a proprietary data set, unique data, whether that's MSCI, S&P Global, Equifax, you mentioned Intuit. Intuit is one of those. Think of the thousands and millions of data points that they have on their customers, have on those small businesses that they have with QuickBooks. We think that data set, ultimately, when we get into the nuts and bolts of what's important in AI, is really going to be the important piece that can drive significant success and hopefully defers a lot of those companies away from being commoditized, which we think is another risk, the disruption risk that comes with AI as well. So yeah, we're still optimistic on Intuit. We believe it's a super high quality business.
All right. Like the stock picks, always helpful for us, especially on a market where stocks are firming up right now. Thanks, Brad.
Yeah, thank you.
Good look at the LRGG ETF there with a few maybe unsung picks in the large cap world. Motorola, Intuit, working alongside a few of the big five. Brad Klattmeyer, Senior Portfolio Manager at Macquarie Asset Management.